Hello everyone, I'm Justin Bender, Portfolio Manager at PWL Capital in Toronto and creator of the Canadian Portfolio Manager blog. Today we'll kick things off by popping the hoods on a number of Canadian equity ETFs for your portfolio's domestic stock allocation. Some of you may be surprised to learn that the world's first ETF was created here in Canada by the Toronto Stock Exchange in 1990. It was called the Toronto 35 Index Participation Units, or TIPS for short. This fund allowed investors to participate in the performance of the Toronto 35 Index without having to purchase the individual shares of 35 different companies. TIPS was followed by a second ETF, the TSE 100 Index Participation Fund, or HIPS for short. It tracked the broader TSE 100 Index. In March 2000, TIPS and HIPS merged into today's single fund, the Ishares S&P Tsx 60 Index ETF, or XIU. The XIU fund is still the largest ETF in Canada today, with assets under management just shy of $10 billion. XIU tracks the S&P TSX 60 Index, which was created by Standard & Poor's to track the performance of 60 large Canadian companies. Its largest holdings include a number of household names among Canada's dominant industries. Each company in the S&P TSX 60 Index is weighted according to its float-adjusted market capitalization. A company's market capitalization, or market cap, is calculated by taking its current stock price and multiplying this figure by the number of shares the company has outstanding. For example, suppose Husky Energy has 1 billion shares outstanding with a current price of $20 per share. Its market cap would be $20 billion. If the market cap of all companies in the index had a worth of $1.8 trillion, Husky Energy would make up about 1.11% of the index. Under a float-adjusted market cap, index managers only count shares that are available to investors, rather than all of a company's outstanding shares. They generally exclude shares that are closely held by control groups, other publicly traded companies, or government agencies. Continuing with our Husky Energy example, the company is controlled by Hong Kong billionaire Li Ka-shing, who owns approximately 70% of the outstanding shares, which leaves only 30% of the shares for regular investors, or 300 million shares in our example. If each share is worth $20, its float-adjusted market cap would be $6 billion, which is 300 million shares times $20 per share. Assuming the total float-adjusted market cap of all 60 companies within the S&P TSX 60 Index was also lower, maybe around $1.7 trillion instead of $1.8 trillion, Husky Energy would make up only about 0.35% of the total float-adjusted index weight, which is calculated as $6 billion divided by 1.7 trillion. Float-adjusted market caps are meant to create an index where each component's weight best reflects practical realities for the market involved. Still, some well-deserving companies may not make the cut. For example, large-cap companies like Shopify, Fairfax Financial, Canopy Growth Corporation, and Aurora Cannabis are currently excluded from the S&P TSX 60 Index due to a Standard & Poor's sector weighting rule. To maintain sector weights similar to the overall Canadian stock market, the Index Committee replaces some large-cap companies with smaller ones. This may be a hard pill for passive investors to swallow, as this arbitrary sector rule could be considered by some indexing purists to be active stock picking. If you feel like you're missing out on the returns of these and other excluded Canadian companies, there's another fund that can complete your ETF package. As the name suggests, the Ishares S&P TSX Completion Index ETF, XMD, complements XIU by including the handful of omitted large-cap stocks just described, plus a healthy dose of mid- and small-cap stocks. The XMD fund follows the S&P TSX Completion Index, which in turn tracks the performance of about 188 mostly small and mid-sized Canadian companies. By allocating about 75% of your investment dollars to XIU and the remaining 25% to XMD, you gain exposure to most of the Canadian stock market at an annual cost of about 0.29%. By now you may be thinking, wouldn't it be easier if there was a single index that followed a combination of the S&P TSX 60 Index and the S&P TSX Completion Index? You're right, which is why there's the S&P TSX Composite Index. Considered by many to be the benchmark index for Canadian stocks, it includes about 248 companies and covers approximately 95% of the Canadian stock market. You may also wonder whether there's a single ETF for investing in all 248 companies in the composite index, so you can invest in one fund instead of two and achieve the same goal. Good news, not only is there an ETF for that, there are two possibilities. The iShares Core S&P TSX Cap Composite Index ETF, XIC, and the BMO S&P TSX Cap Composite Index ETF, ZCN. Both ETFs have an annual cost that is much lower than the weighted average cost of XIU and XMD, making them more cost-effective alternatives to the multi-fund approach. You may notice each of the ETF names include the term capped. Not to be confused with our earlier conversation about market caps, the similar term indicates that all company weights will max out or be capped at 10% if they happen to get too big for their own good. This was the case with Nortel in 2000, when its uncapped value would have accounted for more than a third of the S&P TSX Composite Index. Standard & Poor's launched its capped index in January 2001, and around the same time, Nortel's price steadily fell from $124 per share to $22 per share between August 2000 through March 2001. After the 82% decline, Nortel ended up accounting for less than 10% of the index on its own. In fact, no security in the S&P Tsx Composite Index is currently above 10%, so it's essentially identical to the S&P TSX Capped Composite Index at this time. That said, it's still good to know the cap is there if we ever need it. When Vanguard arrived in Canada in 2011, it launched the Vanguard Footsie Canada Index ETF, VCE, which follows the Footsie Canada Index. Footsie stands for Financial Times Stock Exchange. The Footsie Canada Index includes about 61 Canadian large-cap stocks, so very similar to the S&P TSX 60 Index. If you combine about 79% of this large-cap index with roughly 21% of the Footsie Canada Small-Cap Index, you end up with the Footsie Canada All-Cap Index, which is very similar in composition to the S&P TSX Capped Composite Index. The reference to all-cap in the name indicates that the index tracks the performance of small, mid, and large-cap companies. This time, the term is not to be confused with capped ETFs. In 2013, instead of augmenting VCE with a small-cap ETF complement, Vanguard jumped directly to competing with XIC. It did so by launching the Vanguard Footsie Canada All-Cap Index ETF, VCN, which follows the broader Footsie Canada All-Cap Index. This index includes the same 61 larger companies in the Footsie Canada Index, plus another 151 or so smaller companies, for a total of about 212 companies. Although VCN holds 36 fewer stocks than XIC, these 36 stocks account for only about 4% of XIC's total value. The majority of this 4% difference is represented in just a handful of stocks. Shopify is the most obvious exclusion from VCN due to Footsie's choice to allocate the company to its US equity index instead of their Canadian. A number of Brookfield Limited partnerships are excluded from VCN as well, as LPs are ineligible for inclusion in Footsie's global equity indexes. However, these and other stock exclusions are unlikely to materially impact the future return differences between VCN and XIC. In fact, since 2003, both of the ETF's underlying indices have returned an identical 8.7% on an annualized basis. RBC was a little late to the game, but in 2017 they launched the RBC Canadian Equity Index ETF, Arkan, which tracks the Footsie Canada All-Cap Domestic Index. The term domestic in the name indicates that this particular index methodology does not apply any foreign ownership restrictions when calculating each individual company's weight in the index, whereas the Footsie Canada All-Cap Index does adjust company weights for foreign ownership restrictions. It's interesting to note that the S&P TSX Capped Composite Index does not adjust their company weights either with regards to foreign ownership restrictions. For example, Bell Canada is subject to the Telecommunications Act, which governs the Canadian ownership and control of Canadian telecommunications carriers. The Act restricts foreign investment in voting shares of BCE to a maximum of 33 1/3%. If we view the weight of BCE in each of the broad market ETFs we've just discussed, we find that all of them have a 2.1% weight to BCE, with the exception of VCN, which has a lower weight of 0.7%. If we divide 0.7% by 2.1%, we end up with 33.33%, the maximum foreign ownership of the company allowed. At the beginning of 2019, RBC and BlackRock Canada announced an ETF partnership under the brand RBC Ishares. On or around April 5, 2019, they'll also be merging Arkan into XIC, which may have tax consequences for the current unit holders of Arkan. Due to this upcoming taxable disposition, it'd be prudent to avoid Arkan as a core Canadian equity ETF holding going forward. So there you have it, a collection of ETF solutions to consider for creating broad market Canadian equity exposure. Don't obsess over which one is the best. Any of them should get the job done, and all of them are strongly preferred over spending time and energy trying to pick individual stocks on your own. Before we wrap, I've got one more point to make. It's well known that our Canadian stock market is overexposed to 4 sectors: financial, energy, industrials, and materials. No matter which Canadian broad market ETFs you choose, these 4 sectors will end up representing approximately 3/4 of the value of your holdings. The best way to easily diversify away from this sector risk is to include a healthy dose of global stocks in your overall equity allocation. Fortunately, that gives me plenty more to discuss in future installments of my Understanding ETF series. Next up, I'll take a closer look at broad market US equity ETFs.